I'm Anthony Smith with HFG Trust, and this is the Chart of the Week video. Hello, and welcome to our weekly video. The CPI for September came out yesterday, and as a quick reminder, CPI is the Consumer Price Index, which tells us how much prices for a basket of goods and services have increased over the past year. Basically, it's a measure of inflation. And the reading for September was quite high at 5.4%, and it's been quite high for about 6 months now. You've got shipping challenges, you've got shortages of materials, high commodity prices, rising wages, all contributing to the higher prices that are being passed along to us. We haven't seen persistent inflation above 5% since the 1980s. If you look at this chart, that green dotted line is at 2%, and that represents roughly what the Fed targets for inflation in the long term. Now, we're well above that right now, and for the loyal watchers of this video series, you know one thing about me, and it's that I have been quite skeptical of the transitory inflation narrative that is being peddled by our central bankers. Of course, they're saying it's transitory. They have a vested interest. If it's transitory, then they can justify printing money and keeping interest rates low in order to nurse the jobs market back to pre-pandemic levels. If you have nerd-like tendencies like me, you can go to the Bureau of Labor Statistics website and look at the Cpi Detail. You can see the components that make up the basket of goods and services. And if you were to do that, you'd notice that the components that were blamed for the initial spike in inflation that we saw in the spring, they were so-called economy reopening sensitive categories. And that's what was being blamed for the inflation at the time. But in September, it was more than just these reopening linked categories that drove the CPI higher. And so that could mean that inflation is becoming more persistent, less transitory. Another critical piece in all of this is that when it comes to inflation, expectations matter. And expectations matter because if people expect prices to go higher, it's easier for companies to raise prices, but it also means that workers will be demanding and getting higher wages. The New York Fed, and we're going to switch charts here. The New York Fed has a survey of consumer inflation expectations. And what you're looking at here is in the median inflation expectation 3 years into the future. And this survey has only been around since 2013. This is a 5-year chart that you're looking at, but it's the highest on record. So expectations for inflation are rising, and that could result in price increases that are entrenched and persistent going forward. So why should you care about all this? The obvious is that nobody likes to pay higher prices for goods and services or the same goods and services. But let's focus on investment management. Anthony, talk to us about our portfolios and how to protect them and grow them in the long term. Is it finally time to sell all your stocks and bonds and buy hard gold? Of course not. So let's look at the stock piece first. It's very important to be invested in companies that have the pricing power to keep pace with inflation by passing on all of the price increases they're seeing, or their cost increases. And so they're maintaining margin and growing margin. Stocks can be great investments in moderate inflationary environments. As for the fixed income piece, it still has a role, but be aware that you are probably in high quality bonds and or longer duration bonds that do generate income, but that income is being outpaced by inflation. So while bonds serve a purpose in reducing portfolio volatility in scary market periods, you likely will be losing purchasing power over time in that part of your portfolio, at least in the intermediate term. So it could be worth revisiting your mix of stocks and bonds. And depending on your situation, you may want to look at bonds specifically as a source of liquidity or cash that you may need in the next 5 years or so. And it could be that if you look at it that way, that it could be time to increase your allocation to stocks if you don't have intermediate term cash needs. Now, there's a lot to digest there, but this is something that we think about a lot. Please call us if you have any questions. That is it for this week. Thank you very much for watching.